Alrighty, we're looking at the Jerry Lawson case study. Let's scroll down and read the first question. RISO is most accurate with respect to statement 1 only, statement 2 only, or statements 1 and 2. Let's start reading. Jerry Lawson is an equity portfolio manager at Green Deals Investment Management, an asset management firm in the U.S. Every quarter, Lawson hires a financial consultant to perform a thorough analysis of the portfolio holdings in his clients' accounts. For the next 4 quarters, Lawson hired Joseph Riso, a financial analyst, and an expert in performing portfolio evaluations and measuring returns. While talking about appropriate benchmark construction during an introductory meeting with Lawson, Riso made the following comments. So it looks like these are the two statements we want to be looking at. Statement 1. At the investment manager level, a number of different types of benchmark can satisfy the criteria for an acceptable benchmark. Of these types, the custom security benchmark is the one that meets all of the required benchmark properties and satisfies all of the benchmark validity criteria. So this statement, we're going to give this a check mark. That is a correct statement. A custom security benchmark is typically going to be the best fit for any manager because it's going to only include securities that they would that manager would actually pick. And so the real measurement kind of comes into play where which securities they're overweighting or underweighting relative to that benchmark. But we don't want a benchmark where there's a lot of securities that the manager would never pick because they'd be screened out at some place in their process. So statement 1 is correct so far. Statement 2, broad market indices as benchmarks are unambiguous. However, style indexes and factor model-based benchmarks can be ambiguous and thus are sometimes not appropriate to serve as benchmarks. This is also a correct statement. And so the key here is style index and factor model-based benchmarks can be ambiguous and are not always appropriate to serve as benchmarks. Just because somebody, to give a more concrete example, so this is going to be a check mark, correct. But to give a more concrete example, I may run some type of large cap value strategy. So one would think, oh, the Russell 1000 value is that would be like the style index as a benchmark example. But just because I run value the way I define value might be different than how the index defines value. Value for me might be based on what I think the value of the companies are. And so, whereas the value of the style index of the Russell 1000 is basing it more so just on the price to earnings ratio. So there's different definitions of different styles. And so for that reason, just because the style name is the same doesn't mean it's always going to be an appropriate benchmark. So both these statements are going to be correct, and we'll go with answer C. Question 2. With respect to the information Riso gathered about the institutional fund, which of the following points most likely indicates that the benchmark is of poor quality? Point 1, point 2, or both points 1 and 2? Scroll up and start reading. We left off right here under statement 2. After the meeting, Riso was assigned the task of analyzing the quality of the benchmark for an institutional fund worth $10 million and a private wealth account worth $7 million. The institutional fund constitutes mostly of large cap value stocks, both domestic and international. During his analysis of the fund's benchmark, Riso gathered the following information. When large cap stocks outperformed the market as a whole, the fund produced a positive excess return relative to its benchmark. And 2, when large cap growth stocks underperformed the market as a whole, the fund outperformed the market, but the benchmark underperformed the market. So the answer for this ends up being basically that neither point by itself is kind of substantial on its own to tell us that it's a poor benchmark. So it ends up being answer C, both points 1 and 2 are going to indicate that the benchmarks of poor quality. But let's just dig into these a little bit more. So starting with point 2, when large cap stocks are underperforming, the fund is outperforming the market. That's consistent. So if large cap growth is underperforming, that means that large cap value, which is the style, is likely going to outperform. So the fund is outperforming the market. But the benchmark is underperforming. if we have a good benchmark that is tracking the large cap value stocks we're investing in, then that likely also should have outperformed the market. So that's going to be indicate poor quality of the benchmark. And then for point 1, when large cap growth stocks outperform the market as a whole, the fund produced positive excess return relative to its benchmark. Growth outperforming value shouldn't really matter for our manager returns. This is a style issue, not necessarily a benchmark issue. So that's going to indicate poor quality as well. So we can kind of conclude C is the right answer. Question 3, with respect to the information Riso gathered about the private wealth account, which of the following points most likely indicates that the benchmark is of poor quality? Point 4 only, points 3 and 4, or points 1 and 3? All right. So we left off right here. We'll start reading. Riso then proceeded towards evaluating the benchmark quality of the private wealth account owned by Kelly James, a practicing physician in a community hospital. The account has a stated investment mandate that permits active management using long positions only. As part of his evaluation process, Riso gathered the following information. So it looks like these are the 4 points here that we'll be looking at, and we need to look at 1, 3, and 4. 2 isn't in any of the answers, so we can just kind of skip over that information for time's sake. Answer 1, or point 1, the historical beta of the account relative to the benchmark equaled 1.02. So a beta of 1.02 would indicate being very close to the benchmark. I mean, 1.00 is what you would need to be exactly in line. So that's indicating that similar beta to the benchmark, no indication there of poor quality. So we can go ahead and cross off 1. And in turn, we can go ahead and get rid of C, since that includes point 1. Point 3, over the past month, the risk exposures of the benchmark were significantly greater than the risk exposures of the managed account. So active managers are just that. They're active, and when they do that, they need to take different risk exposures from the benchmark. So just by having more risk exposure than the having less risk than the benchmark, that's really just indicating the positioning of that manager. They're likely expecting some type of downturn or something in the market, so they're more protective and defensive in how they have their portfolio positioned. So we can rule out this as an option as well. No indication of poor quality there. So it looks like we're just left with A, point 4. So let's make sure point 4 is indicating poor benchmark quality. The ratio of negative active positions to positive active positions was 1.5. So the indication of negative to active positions, this is indicating that they're holding 60% of the portfolio in negative positions, which means they're going short. And let's see. This is right here. This is a long only account. So if we think that if there's long only, but there's also some shorting being involved here, the benchmark is likely not lining up. So it's probably some type of benchmark mismatch there. So we can go with a 0.4 is the only one indicating poor quality. Question 4, which of the following is least accurate about the performance of Crest Enterprises pension account during June 2010? A, fund sponsors invested in all of the managers and asset categories precisely at the established policy allocations. B, during June 2010, the return due to style bias was positive. Or C, during June 2010, the manager's active management decisions had a positive impact on the change in the values fund. So we are looking for least accurate in our answer. So 2 of these are going to be accurate, 1 will not. We left off here. Let's read, and we're probably going to read down here to this last exhibit. Lawson is also responsible for heading a portfolio management team for a large pension fund sponsored by Crest Enterprises, a large firm operating in the industrial sector of the U.S. economy. The financial committee at CE instructed Lawson to perform a thorough evaluation of the performance of their pension assets for the month of June 2010. Lawson assigned this task to Riso and Andrew Ellard, a financial analyst at GDIM with considerable experience in performance evaluation of institutional accounts. After a comprehensive assessment and performing rigorous calculations, Riso and Ellard came up with the numbers that helped them in determining the sources of the fund's returns. A portion of the results of their macro attribution analysis is provided in Exhibit 1. So the macro attribution analysis is going to kind of tell us, give us some more color on the actual performance of the fund, so we can use this to kind of determine which of these are accurate and not accurate. So looking back at these answers, fund sponsors invested in all the managers and asset categories precisely at the established policy allocations. So this is going to be indicated by the allocation effect. So if we're investing at the precise policy allocations, that would indicate a zero allocation effect. We'd have allocation effect if we were overweighting or underweighting certain managers or asset categories. So that is an accurate statement. We can go ahead and cross off A. Answer B, during June 2010, the return due to style bias was positive. So for style bias, we're going to be doing style minus the asset category, which is going to give us our answer. So style is going to be right here, that first bullet, style, which gives us 3.65, and then we're going to subtract out our asset category benchmarks, 3.76, and that's going to tell us how our style bias did. So essentially, because we have a style bias of a certain way, our benchmarks return 3.65, whereas if we didn't have that bias like the rest of the category, we would have gotten 3.676. So we take the 3.67, subtract out 3.76, and we can see that gives us a negative number. So it looks like we had positive, we need a negative number, so B looks like it'll be our answer since that's not accurate. And then lastly, during June 2010, the manager's active management decisions had a positive impact on the change in the fund's value. So for here, we're going to be looking at the actual return we had and then subtract out our style benchmarks. So we can see if we subtract those two, this will be a positive number. So we did have positive impact from active management. So we can rule out C and conclude that we're going with B.